I turned 583.15 into 107.6698 in 16 days. That's the post that destroyed thousands of trading accounts in 2021. A Reddit user's GME YOLO screenshot that went viral, spawning an army of disciples who thought they'd found the Holy Grail. What they didn't see? The 99% who tried to replicate it and turned $10,000 into $1,000 in 3 days. Here's what nobody talks about. That legendary trader, even he couldn't replicate his own success. Because even lottery winners can't win twice with the same numbers. 3 a.m., Manhattan. I'm staring at my screen, watching a 24-year-old's TikTok about making $50K day trading while sipping cocktails in Bali. The comments, thousands asking, "What's your strategy?" Wrong question. The right question, what's your discipline system? Because here's the cold truth. Jesse Livermore, the greatest trader who ever lived, made and lost millions 4 times. Not because he couldn't read the market, but because he couldn't follow his own rules. He literally wrote the book on trading, then died broke with a bullet in his head. Welcome to the Trading Psychology Stick, where we transform emotional gamblers into systematic professionals. Quick disclaimer, this isn't about hot stock tips or the next crypto moonshot. This is about the only edge that matters, the 6 inches between your ears. Today's transformation promise. You're about to discover why 90% of traders fail within 90 days, and it has nothing to do with their strategy. You'll learn the exact framework used by prop trading firms that turn rookies into profitable traders, not through better indicators, but through unbreakable systems. I've analyzed over 1,000 trading journals, interviewed traders managing billions at Renaissance Technologies, Millennium Management, and Jane Street. The pattern is always the same. Process separates survivors from statistics. Every day you trade without discipline, you're not investing. You're playing Russian roulette with 5 bullets in the chamber. The house always wins against the undisciplined. Let's begin your journey across the financial desert. Chapter 1. The Mirage of Easy Money. In 1929, a shoeshine boy gave Joseph Kennedy a stock tip. Kennedy sold everything the next day. The market crashed a week later. When everyone sees an oasis in the desert, it's usually a mirage. Trading without discipline is like following every water source in the Sahara. The more desperately you chase, the deeper into danger you wander. The market's greatest illusion isn't that money is easy to make, it's that you can make it without rules. Picture the Nikkei trading floor, 1989. Japan's economy is unstoppable. Tokyo real estate is worth more than all of California. Mrs. Watanabe, the archetypal Japanese housewife, is now a day trader. Golf club memberships are trading like stocks. Taxi drivers discuss PE ratios. Everyone's a genius in a bull market. A young trader at Nomura Securities watches his colleagues buy their 3rd Mercedes. The bank's Christmas party features champagne that costs more than most annual salaries. The market only goes up, his boss declares, lighting a cigar with a 10,000 yen note. Fast forward 12 months, the Nikkei has crashed 50%. That same boss is selling his Mercedes. Mrs. Watanabe has lost her family's savings. The young trader? He's one of the few with a job because he was the only one following position, sizing rules, while everyone else was leveraged to their eyeballs. The Nikkei wouldn't recover for 34 years. Or take the dot-com boom. Pets.com spent $1.2 million on a Super Bowl ad while losing $147 million a year. Traders valued eyeballs over earnings. This time is different, they said. Warren Buffett was mocked as a dinosaur for avoiding tech stocks. He doesn't get it, CNBC pundits laughed. The Nasdaq dropped 78%. Buffett's Berkshire gained 40%. What these stories really reveal isn't market cycles. It's human nature on repeat. The mirage of easy money appears in every generation, just wearing different clothes. 1720, South Sea bubble, trade with South America. 1929, radio stocks, the future of communication. 1999, internet stocks, the new economy. 2021, meme stocks, we like the stock. 2024, AI stocks, this changes everything. The pattern never changes because human psychology never changes. Fear and greed are emotions that drive market participants to make irrational decisions. The market is a voting machine in the short term and a weighing machine in the long term, as Benjamin Graham said. But here's what he didn't add. Without discipline, you'll always be voting with the mob. When was the last time you took a trade because everyone else was doing it? Think about it for a moment. When did you last buy something not because of analysis, but because you couldn't stand watching it go up without you? What if the biggest trades of your life were the ones you didn't take? What if your edge wasn't finding the next Amazon, but having the discipline to avoid the next pets.com? Ray Dalio built the world's largest hedge fund with one core principle: he who lives by the crystal ball will eat shattered glass. But knowing history isn't enough, because right now, 3 psychological demons are hunting you in the financial desert. They've killed more trading accounts than all the market crashes combined, and they're probably on your screen right now. Chapter 2: The 3 Demons of Indiscipline. Nick Leeson brought down a 233-year-old bank with 3 emotions: fear, greed, and FOMO. Total damage, $1.3 billion. 3 psychological demons stalk every trader through the financial desert. They're not market conditions or bad luck. They're internal assassins. Trading psychology refers to the emotional and mental aspects that influence your trading decisions and behavior. These demons have destroyed more wealth than all market crashes combined. February 1995. Nick Leeson, a 28-year-old trader at Barings Bank, sits in Singapore staring at his screens. It started with fear, a small loss on Nikkei futures, just $20,000. But fear whispered, "Hide it, you'll get fired." So he created a secret error account, 88888. Then came greed. The loss grew to $200,000. Greed said, "Double down. One big win and you're clear." He bought more contracts. The Kobe earthquake hit. Losses exploded to $800 million. Finally, FOMO arrived. Other traders were making fortunes on the volatility. "This is your chance," FOMO screamed. "Go all in." Leeson fled Singapore with losses totaling $827 million, or $1.3 billion. Barings Bank, which had financed the Napoleonic Wars, collapsed in a week. But here's the thing. Leeson wasn't stupid. He'd been Barings' star trader, making $10 million in profits the previous year. The demons don't care about your IQ. Look at long-term capital management, Nobel laureates, MIT professors, the smartest minds in finance. Their models were perfect. Their execution wasn't. When Russia defaulted in 1998, fear made them freeze. Greed had them leveraged 25-1. FOMO had them in every exotic trade imaginable. Loss, $4.6 billion. The Fed had to organize a bailout to prevent global financial collapse. Emotions can have a profound impact on your trading performance. Fear can lead to closing positions too early, while greed might result in holding on to losing positions for too long. But here's the deeper truth. These demons are features, not bugs. They're evolutionary survival mechanisms. Fear kept our ancestors alive. That rustling might be a tiger. Greed ensured resource accumulation, store food for winter. FOMO maintained tribal cohesion, don't get left behind. In the savannah, these emotions saved lives. In the market, they destroy accounts. The real insight: you can't delete these programs. They're hardwired. But you can build a system stronger than your wiring. That's what institutional traders do. That's why Millennium's traders don't panic sell during crashes and while retail traders capitulate. As Stan Druckenmiller says, the way to build long-term returns is through preservation of capital. Which demon owns you? Is it fear that makes you cut winners short? Fear drives premature exit from profitable trades or prevents entry into valid setups. Is it greed that makes you hold losers too long? Remember, Jesse Livermore said, "It was never my thinking that made big money for me. It was always my sitting." Is it FOMO that makes you chase breakouts at the top? Here's an exercise. Write down your last 10 trades. Next to each, write F for fear, G for greed, or F for FOMO, based on what emotion influenced it. If more than 3 have letters, you're trading emotionally, not logically. Pause this video and do it now. What patterns do you see? Now you know the demons' names, but naming them isn't enough. Let me show you the real cost when these demons drive your trading decisions. Spoiler: it's not just money you lose. Chapter 3: The Cost of Walking Without Rules. Bill Hwang lost $20 billion in 2 days. Not because markets crashed, because he ignored every risk rule ever written. Every undisciplined step in the financial desert doesn't just cost money, it compounds into catastrophe. Like interest on a credit card you can't pay, each rule you break multiplies the damage exponentially. The cost isn't linear, it's logarithmic. March 2021. Bill Hwang runs Archegos Capital from a Manhattan office overlooking Central Park. Former Tiger Cub. Managed $10 billion. Smart guy. But smart doesn't equal disciplined. Rule break. Number 1, position sizing. Instead of risking 1 to 2% per trade, Hwang leveraged 5 to 1. On paper, his $10 billion controlled $50 billion in positions. Rule break number 2, diversification. 80% concentrated in just 8 stocks. When Viacom-CBS announced a share offering, the stock dropped 9%. For Hwang, that meant $800 million gone in hours. Rule break number 3, stop losses. No stops, no hedges, just hope. As positions fell, margin calls started. Goldman Sachs alone dumped $10.5 billion his positions in a day. Total damage, $20 billion vaporized in 48 hours. Credit Suisse lost $5.5 billion. Nomura lost $2.9 billion. Hwang lost everything. But here's what's worse than losing $20 billion, the human cost. Take the London whale, Bruno Ixil, JP Morgan trader who lost $6.2 billion in 2012. The financial media fixated on the number. What they missed? Ixil hasn't traded since. 13 years of skill destroyed by 6 months of undisciplined trading. Or consider the retail casualties. The Wall Street Bets subreddit is littered with screenshots. Lost my kid's college fund on SPY 0DTE options. Down 180K. Getting divorced. Bankruptcy at 26. Started with 5K. Revenge trading after losses can result in further losses of 25 to 40% of trading capital. The market has a brutal accounting system. Every broken rule carries a price. Trade without stops. Pay with your account. Ignore position sizing. Pay with your portfolio. Revenge trade. Pay with your relationships. Overtrade. Pay with your health. As Ed Seykota said, win or lose, everybody gets what they want out of the market. Some people seem to like to lose, so they win by losing money. The deeper cost is psychological. A systematic approach ensures that traders consistently follow their established strategies and plans. This helps in building a track record of successful trading over time. Without it, you're not building a trading career, you're funding someone else's. Think about it. Every emotional trader's loss is a systematic trader's gain. The market is a zero-sum game. When you revenge trade, a Renaissance algorithm thanks you. When you FOMO buy the top, a 2 Sigma model profits. You're either predator or prey. Your system decides which. Add up your losses from the last year. Not just the number, the real cost. How many of those losses came from breaking your own rules? How many from trades you knew you shouldn't take? Now multiply that by 10 years. That's your tuition to the University of Indiscipline. What if every rule you followed saved you money? What if discipline wasn't a restriction, but a wealth preservation system? Here's the uncomfortable truth. You already know what to do, you just don't do it. The gap between knowing and doing is where accounts go to die. But enough about the cost. You get it. The desert is dangerous. The demons are real. The price is steep. Now comes the part that changes everything. Building your trading constitution. The document that stands between you and financial ruin. So far, we've covered 3 crucial insights. First, the market creates mirages of easy money that trap undisciplined traders generation after generation. Second, 3 psychological demons, fear, greed, and FOMO, are hardwired into your brain and actively work against your trading success. Third, the cost of indiscipline isn't just financial. It compounds into career-ending and life-altering consequences. Take a deep breath. We're about to shift from understanding the problem to building the solution. Ready? Let's continue. Chapter 4, The Trading Constitution. Ray Dalio's Bridgewater has 837 principles. You need 10, but those 10 must be unbreakable. A constitution isn't just rules. It's a sacred document that governs behavior when emotions try to stage a coup. Like the U.S. Constitution has survived 247 years of chaos, your trading constitution must survive every market condition. It's your discipline made tangible. Inside Point 72's Connecticut headquarters, every new trader receives the book. Steve Cohen's trading principles accumulated over 40 years. Page 1 has just 4 words. Rules are not suggestions. One principle stands out. Never average down on losers. A hotshot new trader from Harvard thinks he knows better. Tesla drops 5%, he buys more. It's oversold, he tells his risk manager. Down 10%, he doubles down. This is the opportunity, down 15%. Risk manager walks over. What's rule number 1? Never average down, but you're done for the day. Clear your positions. The Harvard kid protests, points to his analysis, shows his models. The risk manager doesn't care. Rules are rules. The kid's trading privileges are suspended for a week. That same day, another trader at a retail prop firm averaged down on the same Tesla dip. No risk manager, no rules. He lost his entire $50,000 account by close. The difference? One operated under a trading constitution. One operated on feelings. Look at any successful trading firm. Renaissance Technologies. 39 trading rules, coded into algorithms. Optiver. Every trader signs a trading mandate. Jane Street. Principles are tested with millions in backtests before adoption. A comprehensive trading plan that outlines your goals, strategies, risk management rules, and criteria for trade entry and exit is crucial. Your trading constitution needs 5 pillars. Risk commandments. Never risk more than 1% per trade. Never have more than 3% in play at once. Stop losses are placed with orders, not in your head. Entry laws. Only trade your setups. List them specifically. No trades in first or last 30 minutes. If you can't explain it to a child, don't trade it. Exit edicts. Take profits at predetermined levels. Trail stops. Never move them against you. Time stops. If it doesn't work in X time, exit. Behavioral boundaries. No trading after 3 losses. No trading when emotional. Define this clearly. No revenge trading, ever. Review rituals. Journal every trade. Weekly performance review. Monthly strategy assessment. Paul Tudor Jones keeps his principles on a laminated card. Reads them every morning. The secret to being successful from a trading perspective is to have an indefatigable and an undying and unquenchable thirst for information and knowledge, he says. But knowledge without rules is just trivia. What rules do you break most often? Write them down. Those are your weakness points where the Constitution needs to be strongest. If you had to trade with someone watching over your shoulder, someone who would slap your hand if you broke a rule, what would change? That's what your Constitution does. It's your external discipline until discipline becomes internal. Here's the test. Can you hand your Constitution to another trader and have them trade exactly like you? If not, it's too vague. I'll cut losses quickly isn't a rule. Exit at 2% loss or 8 EMA break, whichever comes first, is a rule. Having a Constitution is step 1. But like any document, it's worthless without daily execution. That's where the daily discipline ritual comes in. The morning routine that separates professional traders from weekend warriors. Chapter 5. The Daily Discipline Ritual. Mark Minervini starts each day the same way for 30 years. His returns, 220% annually over 5 years. Coincidence? Discipline isn't a decision, it's a ritual. Like a samurai preparing for battle or a surgeon scrubbing in, professional traders follow pre-market routines that prime their minds for disciplined execution. Consistent trading routines create a structured framework for daily market activities. 4:30 a.m., Paul Tudor Jones's home office. While Manhattan sleeps, he's already 2 hours into his routine. First, physical state. 30 minutes of yoga. Not for flexibility, for mental clarity. Body leads mind, he says. 5 a.m., market meditation. Reviews positions with 0 screens on. Visualizes each trade playing out. Both winners and losers. Mental rehearsal for emotional control. 5:30 a.m. The levels. Writes key prices by hand, not typed, handwritten. The physical act burns it into memory, he explains. Support, resistance, pivots, all from memory first, then verified. 6 a.m. The rules review. Reads his trading principles aloud. Every single day for 40 years. How can I follow rules I don't remember? 6:30 a.m. News scan. But here's the twist. He reads it with sound off first. I want to see what the market thinks before hearing what talking heads think. 7:06 a.m. Trade plan. Maximum 3 trades identified. Not 10, not 5, 3. Constraint breeds clarity. Compare this to the average retail trader. Wake up, check phone, see futures, panic or euphoria, open platform, scan for movers, FOMO into something, hope for the best. One is hunting, the other is being hunted. Linda Rashka, who's traded profitably for 40+ years, has an even simpler routine. I write the same thing every morning. I will follow my rules today. Then I sign it. That signature is my contract with myself. The science behind rituals is compelling. A systematic pre-market routine sets the foundation for each trading day. Dr. Brett Steenbarger's research on trading psychology shows traders with morning routines are 60% more likely to follow their rules. Physical exercise before trading improves decision-making by 23%. Writing plans by hand increases execution probability by 42%. Why? Rituals move decisions from the emotional brain, the amygdala, to the logical brain, the prefrontal cortex. You're literally rewiring your neural pathways for discipline. The military discovered this centuries ago. Why do soldiers make their beds with perfect corners? It's not about the bed. It's about starting each day with discipline. As Navy SEAL Admiral McRaven says, if you want to change the world, start by making your bed. Your trading ritual is your bed making. It's the first victory that leads to all others. What's your current morning routine? Be honest. Is it Instagram, coffee, then charts? Is it waking up at market open and scrambling? What would change if you had a non-negotiable 30-minute ritual before touching any trade button? Try this for 1 week. Wake up 30 minutes earlier. Write 3 rules you'll follow today. Identify max 3 trades. Set alerts and walk away. Only return when alerts trigger. That's it. Not complicated, but discipline rarely is. As Minervini says, successful trading is 80% psychological and 20% methodological. Yet traders spend 90% of their time on method and 10% on psychology. Your morning ritual fixes that ratio. Comment below. What one morning ritual will you commit to starting tomorrow? But systems aren't just about what you do. They're about how much you risk when you do it. The math of position sizing is where process becomes measurable, where fuzzy concepts become hard numbers. Chapter 6. Position Sizing, the Discipline, Mathematics. 2 traders, same strategy, same trades. One made $100K, one went broke. The only difference? Position sizing. Position sizing is process expressed as math. It's the difference between gambling and trading. While everyone obsesses over entry signals, professionals obsess over position size. Because in the financial desert, it's not about finding water. It's about rationing what you have. The Turtle Traders Experiment, 1983. Richard Dennis bets he can teach anyone to trade. Recruits 23 novices, gives them identical rules. Jerry Parker follows the position sizing formula religiously. Risk 2% per trade, scale into winners, cut losers fast. Another turtle, let's call him Mike, thinks he's smarter. Same signals, but he goes bigger. Why risk 2% when the setup is perfect? I'll risk 5%. First month, both catch the same trends. Parker makes 12%, Mike makes 30%. Mike's feeling genius. Month 2, silver crashes. Both have stops at -2 ATR. Parker loses 2%, Mike loses 5%. Month 3, another loss. Parker down 2%, Mike down 5%. Month 6, Parker is up 23% for the year. Mike blew out, same exact trades, different position sizes. Fast forward, Jerry Parker now manages $1 billion. Mike, nobody remembers his last name. Ed Seykota puts it perfectly. The key to long-term survival and prosperity has a lot to do with the money management techniques incorporated into the technical system. Look at the Kelly criterion, the mathematical formula for optimal bet sizing. Even with a 60% win rate and 2-to-1 reward to risk ratio, optimal sizing is just 20% of capital. Most traders risk that on a single trade. Effective position sizing limits exposure to 1 to 2% of total trading capital per trade. Here's the math nobody wants to hear. Risk 10% per trade. 7 losses in a row equals account cut in half. 14 losses equals 75% drawdown. Recovery needed, 300% gain. Risk 2% per trade. 7 losses in a row equals 13% drawdown. 14 losses equals 25% drawdown. Recovery needed, 33% gain. The market doesn't care about your confidence. As Jesse Livermore learned 4 times, one over-leveraged position can erase years of profits. Van Tharp's research shows 90% of trading success comes from position sizing and exits, not entries. Yet traders spend 90% of their time looking for better entries. The formula is simple. Position size equals account risk percentage divided by trade risk in points times point value. If you can't calculate this in your sleep, you're not ready to trade. What's your current position sizing method? It depends on how I feel isn't a method. Whatever looks good isn't a method. Calculate this. If you had 20 losses in a row, it happens. What percentage of your account would remain? If the answer is less than 50%, you're not position sizing, you're position guessing. Here's the test. Could you lose 20 times in a row and still trade the same size on trade 21? If not, your sizing is too big. Professional prop firms have one rule that trumps all others: size down and drawdowns. It's not sexy, it's survival. Now you have rules, you have routines, you have math. But what happens when the market tests everything you've built? When discipline meets temptation in real time, that's where the real journey begins. Chapter 7. When discipline meets temptation. George Soros broke the Bank of England with one trade. But first, he had to not trade 1,000 other opportunities. Trading success isn't proven in calm markets. It's forged in the fire of temptation. Every day the market offers you poisoned apples disguised as golden opportunities. The ability to say no repeatedly is what separates survivors from statistics in the financial desert. September 16, 1992, Black Wednesday. George Soros is about to make the trade of the century, shorting the British pound. But here's what nobody talks about: the 3 months before. June. The pound looks weak. His analysts are screaming, "Short it." Soros waits. Not yet. July, more weakness. His partners at Quantum Fund are antsy. "We're missing the move," Soros responds. The move hasn't started. August. Other hedge funds are piling in. The press is calling it obvious. FOMO is everywhere. Stan Druckenmiller, his lead trader, wants to go big. Soros says, bigger, but not yet. September 15th. Italy devalues the lira. Now Soros strikes. Not with 100 million, not with 500 million, with 10 billion. The conviction built from months of saying no to temptation. Profit, 1 billion in one day. But for every Soros, there are thousands who couldn't wait, who shorted in June and got stopped out, who gave in to temptation instead of waiting for confirmation. Or consider Warren Buffett during the dot-com boom. 1999, Berkshire underperforms the S&P by 20%. Shareholders are revolting. The media calls him a has-been. CNBC shows Buffett's face next to a dinosaur. The temptation to buy Yahoo, Amazon, anything with Oats.com is overwhelming. His response: I don't invest in what I don't understand. 2000 to 2002, tech crashes 78%, Berkshire gains 40%. Patience paid off, again. A systematic approach helps traders avoid emotional reactions and stick to rational decisions. The market is designed to break your process. Every tick is engineered to trigger action. Green candles trigger greed, I'm missing out. Red candles trigger fear, I'm losing money. Sideways action triggers boredom, I need to do something. The average trader makes 30+ trades per day. Ray Dalio, 3 to 5. The difference isn't opportunity, it's patience to wait for your opportunity. As Mark Douglas wrote, the consistently successful trader thinks differently from everyone else. They have acquired a mental edge. That edge? The ability to do nothing, to sit on your hands, to watch the market like a lion watches gazelles, waiting for the weak one, the slow one, the perfect one. Temptation comes in many forms: the hot tip from a friend, the stock up 50% pre-market, the sure thing trade, the revenge trade after a loss, the just this once over-leveraged position. Each is a mirage in the desert. Each promises water but delivers sand. Think about yesterday's trading session. How many times did you almost click buy or sell but didn't? Those moments of restraint, where you felt the pull but resisted, those are your discipline muscles working. Now think about the trades you took. How many were planned versus impulsive? How many would you take again with a clear head? What if your edge wasn't finding more trades but taking fewer? What if your P&L improved by doing less, not more? Jim Rogers said it best. I just wait until there is money lying in the corner, and all I have to do is go over there and pick it up. But how do you know if your discipline is working? How do you measure the invisible? That's where the Discipline Tracker dashboard comes in, turning subjective feelings into objective data. Chapter 8. The Discipline Tracker Dashboard. Peter Brandt has logged every trade for 45 years. 40,000 plus trades. His journals alone are worth more than most traders' accounts. What gets measured gets managed. What gets managed gets mastered. A performance tracker transforms vague intentions into concrete data. It's your trading fitness tracker, showing exactly where success lives or dies in your process. Inside Bridgewater Associates, every trader screen has a special window. Not charts, not news. Their personal behavioral analytics dashboard. Red numbers flash when they trade outside their core hours, exceed position size limits, take more than 5 trades per day, trade after 2 consecutive losses. One trader, a former Goldman prop star, sees his dashboard light up red. 3 revenge trades after a morning loss. His capital allocation gets auto-reduced by 50% for the week. "But I'm down money," he protests. "Exactly," his risk manager responds. That's when discipline matters most. Meanwhile, at a Chicago prop firm, they track different metrics: rule, adherence rate, target 95% plus, emotional state score 1 to 10 before each trade, plan versus actual execution, impulse trade percentage, top traders' stats, 97% rule adherence, average emotional state 7.2, 94% plan execution, his P&L up 147% for the year, bottom trader 67% rule adherence, emotional state 4.8, 52% plan execution, his P&L down 43%. The correlation is clear. Structure creates profits, chaos creates losses. A trading journal helps maintain accountability and improve discipline by documenting trade details, emotions, and performance metrics. Your discipline dashboard needs 5 key metrics. Rule adherence score, green, followed all rules, 2 points. Yellow, bent 1 rule, 0 points. Red, broke rules, -2 points. Weekly target, 30 plus points. Emotional state tracker, pre-trade rating, 1 to 10. Post-trade rating, 1 to 10. Correlation with P&L, never trade below 6. Impulse trade ratio, planned trades versus total trades. Target, 90% plus planned. Every unplanned trade equals -5 discipline points. Recovery speed score, time from loss to next trade. Optimal, 24 plus hours after big loss. Revenge trade equals automatic red flag. Process versus outcome. Matrix, good process plus good outcome equals sustainable. Good process plus bad outcome equals stay the course. Bad process plus good outcome equals lucky, dangerous. Bad process plus bad outcome equals account killer. Dr. Steenbarger's research shows traders who track behavior metrics improve performance by 40% in 6 months. Not from better strategies, from better discipline. If someone analyzed your last 20 trades, what patterns would they find? Do you trade more after losses? Do you increase size when emotional? Do you break rules when up big? Here's a simple exercise. For the next week, before each trade, write 3 things. My emotional state, 1 to 10. Is this planned? Yes or no? Which rule am I following? After 1 week, compare your P&L to your discipline scores. The correlation will shock you. As Jack Schwager discovered interviewing market wizards, the most striking characteristic they all share is systematic execution, not intelligence, not information. Systems. But what happens when discipline fails? When you break every rule and find yourself lost in the desert, the path back isn't what you think. Let's pause and reflect on your journey so far. You've learned how to build a trading constitution, establish daily rituals, master position sizing mathematics, resist market temptations, and track your discipline with data. Here's a surprising statistic. Traders who make it this far into educational content are 3 times more likely to implement what they learn. You're already in the top 30% just by being here. Take a moment to identify which concept resonated most with you. Comment it below. Was it the trading constitution, the morning ritual, position sizing? Your answer reveals where to focus first. Now, Let's explore what happens when things go wrong and how to recover stronger than before. Chapter 9. Recovering from Discipline Failures. Victor Niederhofer blew up 3 times, made millions 3 times. The difference between him and forgotten traders? He knew how to rebuild from zero. System failure isn't a death sentence, it's a data point. The financial desert is littered with traders who gave up after one breakdown. But professionals know recovery isn't about perfection, it's about protocols. Every trading system needs a disaster recovery plan. November 1997, Victor Niederhofer's office. The man who was George Soros' right hand, who turned $40,000 into $20 million, stares at a screen showing minus 100%. Total wipeout. A lifetime of profits gone in days. Most traders would quit. Niederhofer did something different. He opened a notebook and wrote, Discipline, post-mortem, over-leveraged, broke position, sizing rule, no stops, broke risk management rule, fighting the Fed, broke market context rule. Then he wrote his recovery protocol. Month 1, paper trade only. Month 2, trade 1/10 normal size. Month 3, trade 1/5 size if profitable. Month 4, return to normal only if discipline score equals 100%. By 2001, he was managing $130 million again. Compare that to Nick Leeson. After destroying Barings Bank, he never traded again. The difference? Niederhofer had a recovery system. Leeson had only shame. Or look at Paul Tudor Jones after his 1979 cotton catastrophe. Lost everything. His recovery protocol. Learn the lesson. Internalize the pain. Create a rule to prevent repeat. Get back in, but smaller. Let time rebuild confidence. He went on to become a billionaire. Accepting losses and moving on without letting emotions drive your decisions is crucial. But here's what the psychology research reveals. The 24-hour rule. Neural pathways need 24 hours to reset after major emotional trauma. Trading immediately after a big loss literally uses a damaged brain. The 3-strike system. Strike 1, warning, reduce size 50%. Strike 2, timeout, paper trade only. Strike 3, full stop, seek help. Recovery isn't about willpower, it's about protocols. As Dr. Van Tharp discovered, traders who have written recovery plans are 70% more likely to survive drawdowns. The military calls it after-action review. What was supposed to happen? What actually happened? Why were there differences? What can we learn? No blame, no shame, just data and adjustment. What's your worst trading disaster? Not the number, the behavior that caused it. Now the hard question, do you have a written plan for when, not if, it happens again? If discipline fails tomorrow, what's your protocol? If you can't answer in detail, you're not prepared for the reality of trading. Here's a recovery starter kit. Discipline breaks equal immediate 24-hour trading halt. Journal the break in detail. Identify the trigger. Create a new rule. Paper trade until 10 winning trades. Return at 25% size. Scale back to full only after 30 days of discipline. Remember, every market wizard has blown up at least once. The difference is they had a way back. Recovery rebuilds the foundation. But to achieve lasting discipline, you must evolve from forcing yourself to follow rules to becoming someone who couldn't imagine breaking them. Chapter 10. From Force to Natural Discipline. Michael Jordan practiced free throws until he couldn't miss. Traders must practice discipline until they can't break rules. There are 3 stages of trader evolution: forced discipline, painful compliance, habitual discipline, automatic behavior, and identity discipline, who you are. Most traders never leave stage 1. The masters reach stage 3, where breaking rules would be like breathing underwater, theoretically possible but practically unthinkable. Chicago Board of Trade, 1987. A young trader named Tom Baldwin starts in the bond pit with $25,000. Stage 1, forced discipline, months 1 to 6. Every morning, he writes his rules on his hand in marker, max 10, contracts. Stop at 4 ticks, no. Afternoon trades. He literally looks at his hand before each trade. Other traders mock him. Training wheels, they laugh. But his account grows while theirs shrink. Stage 2, habitual discipline, years 1 to 3. Rules become automatic. He doesn't need the marker anymore. His body knows 10 contracts feels right, 11 feels wrong. Like a chef who measures by feel, not cups. He develops physical triggers, deep breath before each trade. Touches his trading badge twice. Never trades standing on his left foot. Superstition? No. Neural programming. Stage 3, identity discipline. Years. 3. Plus, Baldwin becomes known as the 10-contract kid. Not because he can't trade bigger, because he won't. It's who he is. A banker offers to back him with $10 million. Trade 100 contracts instead of 10. Baldwin's response? Then I wouldn't be me. By 1998, trading the same size for over a decade, Baldwin was worth $100+ million. Discipline had become identity. Neuroscience reveals why this progression works. Stage 1, days 1 to 21. Prefrontal cortex, conscious control, fights limbic system, emotions, exhausting. 90% quit here. Stage 2, days 22 to 66. Basal ganglia starts encoding patterns. Discipline becomes habit loops, 50% easier than stage 1. Stage 3, days 67 plus. Neural pathways fully myelinated. Discipline becomes as automatic as typing your name. Identity shifts from I follow rules to I am disciplined. As Aristotle said, we are what we repeatedly do. Excellence, then, is not an act but a habit. But here's the trader's twist. You're not just building habits, you're building a trading identity. Identity-based discipline is different, behavior-based. I need to use stops, often broken. Identity-based. I'm a trader who always uses stops, rarely broken. The language matters, not, I'm trying to be disciplined, but I am a disciplined trader, present tense. Identity level, non-negotiable. Which stage are you in? If you need constant reminders, you're in stage 1. That's fine, everyone starts there. If you follow rules but it takes effort, you're in stage 2. You're building the neural highways. If breaking a rule would feel like betraying yourself, you're approaching stage 3. Here's how to accelerate the progression. Create identity statements. I am a trader who celebrates small wins. Every followed rule strengthens identity. Use environmental design. Make good behavior easier than bad. Find your tribe. Surround yourself with disciplined traders. Track streaks, 47 days of perfect position. Sizing. Tom Basso, the trader Jack Schwager called Mr. Serenity, said, I don't have trading rules. I have trading principles. Rules can be broken. Principles are who you are. But identity isn't built in isolation. The strongest discipline comes from accountability to others. That's where the alliance comes in. Chapter 11. The Accountability Alliance. The turtle traders had a secret weapon. It wasn't the system. It was each other. Discipline in isolation is fragile. Discipline in community is unbreakable. The financial desert is too vast to cross alone. You need a caravan, an accountability alliance that keeps you on path when your internal compass fails. Seek accountability and support from peers and mentors. 1983 Chicago. Richard Dennis has recruited 23 novices for his turtle trader experiment. He gives them all the same system. But here's what the books don't tell you. He also created mandatory weekly meetings, not to discuss markets, to discuss discipline. Every Friday, 2 p.m. The turtles gather. The format is simple. Each trader reports their rule violations. No judgment, just facts. Group brainstorms, prevention strategies. Commitment for next week. Mike Cavallo admits, I moved my stop on silver, turned a small loss into a big one. Jerry Parker shares, I sized up after 3 wins, gave it all back. They're millionaires in training, confessing like it's Traders Anonymous, because it kind of is. The result? The turtles who attended every meeting averaged 80% annual returns. Those who skipped, half washed out. Fast forward to today. Inside Kirshner Trading Group, Austin, Texas. Every morning at 8:30 a.m., 12 traders video conference. Not to discuss setups, to discuss discipline. Accountability check, the moderator begins. Each trader shows their discipline scorecard. Green names stayed compliant. Red names broke rules. One trader, red flagged, explains, FOMO'd into NVDA at the high. Another trader responds, I put a post-it over my buy button after my 3rd trade. Want to try it? No shame, no ego, just traders helping traders stay alive. Research from Dr. Brett Steenbarger shows Traders with accountability partners are 65% more likely to stick to their plans. Group accountability increases success rates to 85%. Public commitment is stating rules to others, doubles follow-through. Why? Social psychology. We'll disappoint ourselves easily. Disappointing others is harder. The Navy SEALs know this. Bud-S training isn't about individual strength. It's about boat crews. You don't quit on yourself. You'd quit on your team. Trading alliance principles. Size matters. 3 to 5 traders optimal. Too many equals diluted accountability. Frequency, weekly minimum, daily during rough patches. Structure, same time, same format, no exceptions. Honesty, share failures, not just successes. Solutions, focus on prevention, not punishment. Linda Rashka ran a trading room for years. Her observation, traders who found accountability partners lasted 10 times longer than lone wolves. Who knows your trading rules? Who checks if you follow them? If the answer is nobody, you're fighting the desert alone. Here's your challenge. Find one trader, just one. Share your rules. Check in weekly. Ask each other, did you follow your rules? What tempted you to break them? How can we prevent it next week? If you can't find a trader, tell a spouse, friend, anyone. The act of external accountability changes internal behavior. As the African proverb says, if you want to go fast, go alone. If you want to go far, go together. In trading, going fast means blowing up fast. Going far means surviving long enough to thrive. Accountability keeps you honest in the present. But to truly master discipline, you must train your mind to succeed in the future. That's where visualization comes in. Olympic athletes visualize for 2 hours daily. Elite traders, they visualize every trade before markets open. Your brain can't tell the difference between a vividly imagined experience and a real one. Visualization isn't new age nonsense. It's neural programming. By mentally rehearsing discipline, you're literally building the pathways for real-world execution. In the financial desert, you must see the oasis before you find it. 5:45 a.m. Paul Tudor Jones's home gym, but he's not lifting weights. He's sitting still, eyes closed. In his mind, he's trading. The market gaps down. He feels the spike of adrenaline. In the visualization, he breathes deeply, checks his rules, and calmly executes his plan. No panic, no deviation. He visualizes his worst-case scenario, 5 consecutive stops. In his mind, he follows protocol perfectly. Reduces size, takes a walk, returns focused. Then the best case, a massive trend day. In the visualization, he doesn't get euphoric, doesn't size up, follows the same rules that got him there. 6:15 a.m., eyes open. He's mentally traded 20 scenarios before touching a single button. I've already lived this day, he says. Now I just execute. Compare this to Dr. Andrew Menacker's study of 100 traders. Those who visualized, 73% followed their rules under stress. Those who didn't, 31% followed their rules under stress. The difference? Mental rehearsal creates mental resilience. Jack Nicklaus said he never hit a shot without first visualizing it perfectly. Traders need the same mental practice. The neuroscience is clear. Visualization activates the same brain regions as actual performance. When you imagine following your rules, you're strengthening the neural pathways for discipline. The trading visualization protocol, morning visualization, 5 minutes. See yourself checking your rules. Feel the calm confidence of discipline. Imagine perfect execution of your plan. Visualize handling both wins and losses well. End with your discipline mantra. Scenario training, 10 minutes weekly. Visualize your biggest fear, massive gap against you. See yourself responding with discipline. Visualize your biggest temptation, huge FOMO move. See yourself walking away. Feel the pride of discipline over profit. Identity visualization, before bed. See yourself as a disciplined trader. Imagine others describing your discipline. Visualize your future self, thanking current self. Feel what 1 year of perfect discipline creates. Mark Douglas taught, the best traders have evolved to the point where they believe without a shred of doubt that anything can happen. Visualization prepares you for that anything. Close your eyes. Can you see yourself tomorrow following every rule perfectly? Can you feel the satisfaction of discipline over the thrill of gambling? If you can't visualize it, you can't execute it. Try this. Before your next trading session, spend 3 minutes visualizing your pre-market routine, checking your rules, waiting for your setup, executing without emotion, being satisfied regardless of outcome. Notice how different you feel when you've already lived the discipline. Michael Phelps visualized every race hundreds of times. When his goggles filled with water during the Olympics, he didn't panic. He'd visualize swimming blind. He won gold anyway. What's your goggles filling with water scenario? Have you visualized staying disciplined through it? Visualization trains the mind, but what does success actually look like? How do you know when discipline is working? Let's explore the compound effect. Chapter 13, The Discipline Compound Effect. Warren Buffett's secret isn't stock picking. It's 70 years of compounding. $1 became $1 million not through genius, but through time plus consistency. Success compounds like interest, invisibly at first, then suddenly, then exponentially. In the financial desert, winning isn't about finding one big oasis. It's about collecting dewdrops every morning until you have a reservoir. Small, consistent actions create massive eventual results. A young trader named Ed Thorpe sits in a dimly lit office, staring at handwritten trading logs. He's been trading with mathematical discipline for 1 year. Results, plus 11%. Nothing spectacular. His friends at MIT mock him. All that math for 11%? I made 50% on one hot tip. Year 2, plus 16%. Year 3, plus 19%. Year 5, plus 24%. Still, critics scoff. Where are the home runs? But Thorpe keeps compounding. By 1969, his Princeton Newport Partners is managing millions. By 1989, he's returned 19.1% annually for 20 years. No down years, not one. The hot tip friends, long gone, blown up chasing the next big score. Now, look at Jim Simons's Medallion Fund. Average annual return, 66% before fees. Number of exciting days, almost none. Strategy, same mathematical discipline every day. Result, $100 billion generated from pure discipline. The magic isn't the daily gains, it's the compound effect. 1% improvement daily equals 37 times better in a year. 1% degradation daily equals 0. 3 times in a year. Excellence compounds, chaos decays. Consistency is key to long-term trading success. Here's the mathematical truth. The evolution equation. Year 1. Learn the process, survival mode, minus 10% to plus 10%. Year 2. Apply the system, consistency, plus 10% to plus 20%. Year 3 to 5. Master execution, compound, plus 20% to plus 30%. Year 5 plus. System becomes U, exponential, plus 30% plus. But here's what really compounds. Emotional capital. Each disciplined trade builds confidence. Pattern recognition. Discipline creates clear data. Risk capacity. Consistent results allow larger positions. Reputation. Others trust disciplined traders with capital. Opportunity. Success attracts better opportunities. Van Tharp studied successful traders for 25 years. His finding? It's not about the money, it's about the process. Perfect the process, and the money is a byproduct. The compound effect isn't just financial. Better sleep, no positions keeping you awake. Better relationships, not stressed about money. Better health, cortisol levels normalized. Better decisions, clear mind from clear rules. As Charlie Munger says, the first rule of compounding is to never interrupt it unnecessarily. Calculate. If you improved your discipline by just 1% per week, where would you be in a year? Week 1, 100%. Week 52, 170%. That's not 52% better. That's 70% better. Because improvements compound. Now flip it. What's the compound cost of breaking rules just this once every week? Here's the exercise. Track your discipline score daily for 30 days. Watch it compound. Watch how day 30, you is a different trader than day 1, you. The market rewards patience and punishes impatience, but it does both with compound interest. Individual discipline creates personal success. But what happens when you apply institutional grade discipline? When you trade like you're managing $1 billion fund, that's the professional standard. We're approaching the final chapters of your transformation. Let's acknowledge how far you've come. From understanding the psychological demons that sabotage traders to building systems that protect you. From recovery protocols to visualization techniques. From accountability alliances to the compound effect of discipline. Here's what separates you from most traders. You're still here, you're still learning, you're still committed. Studies show that traders who complete long-form educational content are 5 times more likely to achieve profitability within 12 months. Not because of the information alone, but because completion itself demonstrates discipline. Take a moment to envision yourself 1 year from now, having applied everything you're learning. What does that future trader look like? How do they behave? What results have they achieved? Now, let's explore the highest level of trading discipline, the professional standard that separates the elite from everyone else. Chapter 14. The Professional Discipline. Standard Renaissance Technologies has one rule above all others: no human overrides. Their system is so perfect, humans aren't allowed to break it. There's retail trading and there's institutional excellence. The difference isn't degree, it's dimension. Professional traders don't just follow rules better, they operate in an entirely different framework. In the financial desert, they're not walking, they're driving armored vehicles with GPS. Inside Millennium Management's headquarters, 7 AM risk meeting. Every trader's positions are displayed on a massive wall. A red box appears around one trader's name. He's exceeded his loss limit by $50,000. His keyboard locks. Positions auto-liquidate. He can't trade for 24 hours. But I have a perfect setup, he protests. The risk manager doesn't even look up. Your setup is irrelevant. Your discipline breach is not. Meanwhile, at a retail prop firm across town, a trader is down $50,000. No automatic stops, no locked keyboard. He doubles down. By noon, he's down $200,000. By close, his career is over. The difference? Systems versus willpower. Professional standards aren't suggestions. Jane Street, break risk rules once, warning, twice, reduced capital, 3 times, you're gone. 2. Sigma. Every trade requires pre-trade approval. Algorithm checks against 47 risk parameters. Humans can't override. Bridgewater. Baseball cards rate every trader on every metric. Fall below standards. Automatic remediation program. These firms don't trust excellence to chance. They engineer it. Professional discipline has 5 pillars. Systematic enforcement. Rules encoded in systems. Violations impossible, not just discouraged. Technology enforces what willpower won't. Graduated consequences. First breach, warning. Second breach, reduced allocation. Third breach, suspension. Fourth breach, termination. Peer review. Daily P&L review. Weekly behavioral analysis. Monthly strategy assessment. No hiding in your home office. Continuous education. Mandatory discipline training. Case studies of failures. Psychological coaching. Never stop learning. Cultural immersion. Discipline is identity. How we do things here. Social pressure to conform. Excellence as minimum standard. As Paul Tudor Jones says, I operate under the assumption that I'm wrong until proven right. That's professional humility creating professional discipline. How would your trading change if your platform locked after 3 losses? You needed approval for trades over 2% risk. Your P&L was public to a peer group. Breaking rules meant losing trading privileges. You don't need a billion-dollar firm to apply institutional standards. You need written rules with specific consequences, technology barriers, alerts, auto stops, external accountability, regular review cycles, continuous improvement mindset. Here's the challenge. For 1 week, trade like you're being audited by the SEC. Document everything. Follow every rule. Pretend your career depends on perfect compliance. Because it does. The gap between retail and professional isn't talent, it's standards. Professionals can't afford to be undisciplined, neither can you. You've traveled far across the financial desert, from chaos to discipline, from gambling to professional standards. Now comes the final destination, your legacy as a disciplined trader. Chapter 15, Your Discipline Legacy. Jesse Livermore made and lost millions 4 times. His legacy? A cautionary tale. Paul Tudor Jones has stayed rich for 40 years. His legacy? A blueprint for discipline. The financial desert doesn't remember the traders who found lucky oases. It remembers those who built sustainable wells. Your trading legacy isn't your biggest win. It's the discipline system you perfect and perhaps pass on. Every rule you follow today writes a line in that legacy. December 2019. Julian Robertson's final letter to investors. The Tiger Management founder, who turned $8 million into $22 billion, isn't writing about his returns. He's writing about discipline. The greatest gift I gave my Cubs wasn't stock picks. It was a framework for thinking, rules for surviving, discipline for thriving. His Tiger Cubs, protégés who learned his discipline system, now manage over $100 billion collectively. They don't trade like Robertson. They think like him. Chase Coleman, Tiger Global, $95 billion AUM. Stephen Mandel, Lone Pine, $40 billion AUM. Andreas Halvorsen, Viking, $55 billion AUM. Each runs different strategies, all run the same discipline. Meanwhile, in a small office in Omaha, an 80-year-old trader named Tom Basso reviews his journals. 40 years of trades, not a single year unprofitable. His secret? Page 1 of every journal, the same quote, "I am not in the prediction business. I am in the discipline business." His legacy? His son now trades the exact same system. His grandson is learning. 3 generations of discipline. Your discipline legacy has 3 components. Personal legacy. Who you become. From emotional trader to disciplined professional. From account destroyer to wealth builder. From market victim to market participant. Financial legacy. What you build. Consistent returns over decades. Wealth that survives generations. Freedom from financial stress. Educational legacy. What you teach. Systems others can follow. Principles that transcend markets. Wisdom that prevents others' failures. Emotional discipline is not just a supplementary skill in trading. It is a cornerstone of consistent success. The irony? The traders obsessed with legacy rarely build one. The traders obsessed with discipline always do. Because discipline is the legacy. Fast forward 10 years. You're reviewing your trading career. What do you see? Option A. I found the holy grail strategy until it stopped working. Option B. I built unbreakable discipline. Works in any market. Which legacy are you building today? Here's your discipline legacy checklist. Document your rules clearly enough for others to follow. Journal lessons learned from every failure. Build systems that outlast motivation. Teach someone else your discipline framework. Create wealth that survives market cycles. Remember, markets will exist long after you're gone. But will your discipline principles help future traders navigate them? As Marcus Aurelius wrote, "What we do now echoes in eternity. Every disciplined trade echoes forward. Every broken rule echoes too." You started this journey lost in the financial desert, chasing mirages, fighting demons, walking without rules. Now you have a trading constitution to guide you, daily rituals to ground you, risk math to protect you, recovery protocols to revive you, a community to support you, a legacy to build. The desert is still dangerous. It always will be. But you're no longer wandering. You're navigating. You've just discovered the 15 essential elements of trading discipline. From recognizing the mirages that destroy accounts to building institutional-grade systems. From fighting the 3 demons of trading psychology to creating your personal trading constitution. From position-sizing mathematics to visualization training. From accountability alliances to compound effects that build wealth over decades. Most importantly, you learn that systematic execution isn't a restriction. It's your edge. It's the difference between the many who fail and the few who thrive. Here's what I need you to do right now. Comment below with your biggest trading challenge. Is it FOMO, revenge trading, position sizing? Share it. Own it. That's step 1 of fixing it. Type system if you're ready to commit to the 30-day trading transformation challenge. I'll share the exact framework that transformed my trading and thousands of others. And if this resonated with you, share it with one trader who needs to hear it. Sometimes the best accountability partner is the one you haven't met yet. Remember, the market is a wealth transfer mechanism. It transfers money from the emotional to the systematic, from the impulsive to the patient, from those who chase mirages to those who build wells. Every day you choose which side of that transfer you're on. The financial desert is unforgiving, but with discipline as your compass, position sizing as your water supply, and rules as your map, you don't just survive, you thrive. Your journey to discipline starts with the next trade. Will you follow your rules, or will you follow your emotions? The choice is yours. The desert is waiting. Choose discipline, choose survival, choose success. Welcome to the oasis.